As we look at the market board on this Monday, July 6th, 2026, the United States stock market is currently closed, meaning we are stepping back to analyze the broader picture without the noise of minute-by-minute ticks. Tesla stock concluded its last active market session on July 2nd, 2026, establishing a final closing price of $393.45 per share. This represented a substantial single-day decline of 7.49%, a move that caught a lot of short-term traders completely off guard, given the massive headline news that dropped right before the opening bell. The immediate reaction for anyone looking at a 7.5% drop would be to assume that vehicle deliveries missed the mark or that consumer demand had completely evaporated. But here is the piece of information that flips the typical market narrative completely upside down. The company actually reported a massive beat on its quarterly deliveries, handing over 480,126 vehicles to customers against a Wall Street consensus estimate that sat down at 406,024 vehicles. That's an 18% outperformance, marking their best second quarter in company history. Yet, the price tumbled. This creates a classic institutional paradox where expectation and reality collide in a way that leaves casual participants confused, while professional wealth management firms reallocate their capital behind the scenes. When you see a stock drop 7% on stellar operational news, you're witnessing a classic case of selling the news after a massive speculative run-up. The common belief among retail investors using a standard individual brokerage or tracking their holdings on popular investing sites was that a massive delivery beat would automatically push the valuation to new highs. The reality, however, is that smart capital had already priced in a significant chunk of this optimism during the preceding weeks. If you look at the broader landscape of online investing, many participants who engage in self-investing looked at the delivery beat as a guaranteed green day. But institutional algorithms operating on the Interactive Brokers platform and large-scale funds managing billions saw an asset trading at more than 200 times forward earnings. At that valuation level, a company cannot just beat expectations, it has to completely obliterate them and provide absolute certainty about near-term profit margins. Because the automotive sector is facing structural pricing pressures globally, big institutional players took the opportunity to lock in gains, pulling liquidity out of the equity and leaving individual accounts to absorb the downward momentum. To understand where the stock is going next, we have to look closely at the recent price action and the technical levels that are currently being tested. Dropping down to $393.45 means the price is hovering directly over its ascending trend line, which aligns closely with the key 0.618 Fibonacci retracement level at roughly $395.06. When a stock slices through a psychological support level on high trading volume, it indicates that institutional distribution is actively taking place. During this specific session, trading volume surged to over 73 million shares, which is significantly higher than the typical daily average we have observed over the past few months. This level of volume tells us that this was not just a minor retail panic, it was a coordinated rotation by large asset managers who are balancing their technology exposure. Many of these funds are looking at their allocations to large growth assets, comparing the upside potential here against other major names like Apple stock and Nvidia stock. When capital rotates out of high-multiplier automotive equities, it frequently searches for a home in foundational technology companies that boast highly predictable enterprise cash flows. For the retail traders utilizing a Robinhood app or executing daily trades through the SoFi trading platform, this high-volume drop highlights the structural differences between short-term market sentiment and long-term valuation reality. If you're managing your own online investment portfolio without professional investment help, it's easy to get caught up in the production numbers while overlooking the macro liquidity environment. High interest rates continue to apply pressure to consumer financing options, forcing automotive manufacturers to rely on financing incentives and price reductions to clear out older stock. While the delivery beat proves that inventory is finally moving again, it doesn't tell us what those vehicles actually sold for. That's the hidden tension keeping professional investors awake at night. The delivery numbers show great volume, but the upcoming quarterly earnings report on July 22, 2026 will show us the actual toll these strategies have taken on net income margins, which previously compressed down to under 4%. Let's break down the delivery numbers to see exactly what happened under the hood. Out of 480,126 vehicles delivered, the vast majority were the high-volume Model 3 and Model Y variants, accounting for 467,762 units. The remaining 12,364 vehicles came from the premium segment, which includes the Model S, Model X, the Cybertruck, and the Semi. The critical detail here is the relationship between production and deliveries. The company manufactured 451,758 vehicles during the quarter, meaning they delivered roughly 28,000 more cars than they produced. This is a massive structural turnaround from the first quarter of the year, where inventory swelled by approximately 50,000 vehicles due to logistical bottlenecks and temporary plant shutdowns. Seeing inventory contract indicates that global demand is stable, particularly in regions like Europe, where vehicle registrations showed a massive year-over-year jump during the spring months. Investors tracking these metrics via their Fidelity brokerage or checking updates on the Fidelity mobile app can clearly see that the core business is working hard to clean up its balance sheet ahead of the autumn cycle. However, the primary reason the stock commands such a premium valuation compared to traditional legacy automakers is not the car business at all. It's the rapid scaling of the energy storage business and the market anticipation surrounding autonomous software. Energy storage deployments jumped to 13.5 gigawatt-hours, representing a 40% increase compared to the same period last year. This secondary business unit is growing at a clip that traditional auto analysts often fail to model correctly. For investors who build their long-term wealth using automated wealth management systems like Schwab Intelligent Portfolios or a customized intelligent portfolio setup, these non-automotive segments provide a necessary buffer against vehicle cyclicality. Furthermore, the recent regulatory progress regarding autonomous driving software in the European market has added a structural floor to the asset, preventing a total collapse back towards annual lows. The market is continuously weighing the reality of a capital-intensive manufacturing business against the expectation of a high-margin software and robotics enterprise. Comment below how many shares of Tesla stock you currently hold in your portfolio right now, and whether you are buying this dip or waiting for the earnings report. When we evaluate what this company does at its core, its underlying business model relies on creating a vertically integrated ecosystem that spans clean energy generation, massive localized battery storage, high-volume electric transport, and distributed autonomous computing. Historically, the company proved to Wall Street that electric cars could be manufactured at scale with positive gross margins, a feat that legacy competitors are still struggling to replicate without suffering heavy losses. Past financial reports demonstrate a history of volatile cash flows, punctuated by massive capital expenditure phases followed by surges of high-margin regulatory credit sales. This cyclical pattern has often created massive friction between short-term traders using basic investing sites and long-term institutional holders who tuck these shares away in Fidelity IRAs, Fidelity mutual funds, or broader Fidelity investments accounts for the long haul. The legacy performance shows an organization that has survived severe production bottlenecks by maintaining an incredibly lean structural architecture and avoiding legacy dealership networks. Looking forward toward the final months of 2026, the trajectory of the stock will depend entirely on how the expectation versus reality dynamic resolves during the upcoming July 22nd earnings call. There are two primary scenarios that could unfold from here. In the bullish scenario, the company demonstrates that its factory efficiencies and battery cost reductions manage to offset the price cuts, allowing net margins to rebound significantly. If they can couple stabilizing automotive margins with continued 40% growth in energy storage deployments, institutional capital will likely flood back into the asset via platforms like the Interactive Brokers platform, driving the price back towards its 52-week highs. Conversely, the bearish scenario involves a reality where the massive 480,426 delivery figure was achieved only through